How much premium should you pay for infinite banking? I believe that when you know what's going on, you'll know what to do. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. Today I would like to speak with you about what an appropriate amount of premium is for the purposes of infinite banking. Now, premium is a natural part of the conversation when folks have been exposed to this idea of infinite banking and they've seen my presentation video and we're having a free consultation call about their plans, their aspirations, how they see themselves implementing infinite banking, for what purposes. And premium is something that they may have a fixed idea already just by looking at their budget of what they want to do. But more often than not, it's a question that folks have, and I understand that. I could even say from my own experience, when I saw infinite banking presented to me in 2015, I essentially ended up going with an amount of premium that, yes, I thought about some, but that was also just what seemed to be the normal of other people that were seeing infinite banking and getting started. So while I believe that you should be deciding what is an appropriate amount of premium for you because of your knowledge and understanding of what's going on, I think that there are some helpful questions that will facilitate thought around this concept as well. So I'm never going to tell you your numbers. You are going to tell me your numbers. Let's walk through those, some common scenarios that I try and provoke thought with while addressing what an appropriate amount of premium might be for an individual, because policies are built for the individual. Every individual case is different. The timelines, the purpose, the amounts, all are factors, and there are more of them that go into that. So again, you should decide what's appropriate for you. I'm not going to tell you your numbers. You will tell me what you think is an appropriate amount of premium for you. And it should be based off of your goals, your plans, your aspirations, how you plan on using and implementing infinite banking yourself. And not just in a short range, but in the long range. Again, if we actually do preface this conversation by remembering, and I think this is the best place to preface with Nelson's principles, we should be thinking long range. We should be considering how much premium can we pay, do we want to pay, or have the contractual right to pay, and for how long would we like to be able to do that, because we're thinking long range. Nash's second principle of don't be afraid to capitalize. Again, are we considering a substantive amount of premium, something that will actually move you towards your goals? Again, I would rather take smaller quality steps than to overstep, and yet it should be a substantial amount, so much so that we can accomplish short-range goals, mid-range goals, and then goals that we really perhaps might not even have the vision for yet, because this is the infinite banking concept, but that begins by not being afraid to capitalize. So to say it another way, capitalize your system. Strongly capitalize your system. Nelson's third principle is be an honest banker. Of course, that's going to be important later on, not necessarily so much while thinking about the amount of premium to begin a policy or to add another policy to a system of policies that you've already started, but it's worth mentioning. Not doing business with banks. Now, that could play into your consideration for premiums, because perhaps there are some cash flow inefficiencies that you currently have, whether that's something you need to address with the HR department. Perhaps their tax withholdings are not to your benefit. Perhaps that's something that needs to be dialed in. Perhaps you have some lazy liquid funds in a savings account somewhere, and other things to consider when it comes to that principle of not doing business with banks. I believe that you should be your own banker. You'll have the control. You'll experience the profitability that banks do. So that's worth mentioning. And then the fifth principle of rethink your thinking. Now that's very applicable for even considering premium before you even ever own a policy. So I have some methods that I resort to, that I've developed by having organic conversations with folks, trying to encourage them how to think about their own situation. One of those methods is a savings method. So let me prompt you with some questions. Right now, how much do you currently have saved? How much do you have in an emergency fund, or how much do you have in savings, a liquid amount of capital that you could get to if you needed to or wanted to? How much do you have? This is something that I'll ask you when we speak. How long did it take you to get to that amount? I always like asking that question because, again, pointing to Nash's book, he addresses the human problems like Parkinson's. That's the first law that he addresses in his human problems section of the book, Parkinson's law. We have this natural tendency to spend all that we earn. So are you already saving? How much do you have saved up? How long did it take you to get to that number? That speaks to your habits, your disciplines currently. And it's just helpful to know. And again, if you've not been saving, just recognize that, sure, infinite banking is a beautiful process for you to reacquire the control over the banking function in your life. But if you've not addressed Parkinson's, you will have to if you want to win. I can't do that for you. Nobody else can. You will have to address Parkinson's law and begin saving. And even if you have been saving, that doesn't mean that you've been inoculated against Parkinson's. It's something that we have to readdress. So how much do you have saved currently? How long did it take you to get there? And when it comes to considering redirecting savings or replacing or relocating savings to this optimal asset, this what I would call the ideal asset, the properly structured whole life policy from a mutual company that pays dividends. If we're going to begin saving, again, method number one here, saving. If we're going to begin saving, let's just look at some helpful questions. If you had the kind of month where you walk outside and you've got a flat tire on the car, you walk back in the house and someone tells you that the hot water heater has gone out. I'm just trying to describe, and this will look different for everyone, but if you were having that kind of a month where the things that could go wrong do go wrong, there's still some amount that you could see yourself saving come what may. No matter what, without missing a beat, there's some amount that you could see yourself saving on a recurring monthly basis, let's just say. What is that number for you? This is a number that I will ask you about. This is your safe, this is your secure, this is your certain amount that you could see yourself saving in an ongoing basis. On the other hand, at your best, when all the things are going your way, what is the most ambitious number that's crossed your mind? You've been exposed to this idea of being your own banker. What is the most ambitious number that's crossed your mind? A number that for sure, if you said that in front of a spouse, in front of a friend that had not seen a presentation video or read the book, Becoming Your Own Banker, and you said, well, I'm thinking about paying X amount into whole life insurance. They're going to think you're crazy. They're certainly going to be raising their eyebrows at you. And you know that that number is a stretch for you. And yet it's doable. It's ambitious, but it's doable. What is that number for you? Now, when you have those two numbers, that gives you what I would say is your premium range. This is the range of premium that you're considering paying. And these two numbers are going to be very helpful when we begin talking about structuring the policy. So here's this first method of looking at what amount of premium is appropriate for you. This range of savings. What's your conservative number? What's your most ambitious number? And that's going to be very helpful. Now, beginning the second method of looking at appropriate premium, we have our range. This is just going to be a purely mathematical one. I start with the other because it's very realistic. It's very rubber meets the road. You know those numbers for yourself. This one, now we can begin to just analyze the data. You've got this premium range. Now let's calculate some metrics. Knowing your age and knowing your gross annual income are helpful. Knowing your age is helpful because when we discuss structuring a policy, structuring how long you would like the contractual right to pay a premium matters depending on your age. And then also your gross annual income is helpful here because now that you have a premium range that you're considering, I would like us to calculate what does that premium range represent as a percentage of your gross annual income. And I don't want to throw out any numbers right here, but what I want to say is if the amount of premium that you're considering represents 3% of your gross annual income, I think that's a puny number. It's not going to move you towards your actual goals when we begin thinking about how to use this private banking system, this private banking entity. It's not really going to move you towards your goals, I don't think, because of how insignificant a percentage of your cash flows that is. Whereas if you came, on the other hand, and were considering 3/4 of your gross annual income, that also is not appropriate. That's not a prudent, especially first policy. That's not an appropriate percentage of your cash flows to consider funding a policy with. Do you follow me on that? Now that you've got that premium range, what does that range, the low end, the high end? And I think we'll land somewhere in the middle. I typically tell folks, when you pick your range, perhaps you should consider somewhere in the middle and maybe even a touch towards the conservative side, especially for a first policy. It could be very different if you're talking about a subsequent policy. For example, my first policy is not my largest policy. It's not the policy that I pay the most amount of premium into. It is my favorite just because it's the oldest, it's the most efficient, but it's not my largest. And many of us, most of us probably, looking back, we will say that we started too small. And yet, again, let me reemphasize, I would rather take a quality first step, especially for a first policy. I would rather take a quality first step than to overstep right out of the gate. Do you follow me on that? So I think it's helpful to know what your premium range, or that middle mark, maybe a touch towards the conservative side, what does that represent from your gross annual cash flows or your gross annual income? Is it a puny 3%? Or is it an overly ambitious 3/4 of a percentage of your gross annual income or your gross cash flow? So looking at that mathematical approach, I think, is very helpful as well. A third method of looking at what might be an appropriate amount of premium for you could be what I've just called reverse engineering. If in our conversations that we have had or will have, you've discussed certain goals that you have over the next 12 months, 5 years. If we've discussed some of these things, and if you have an idea of how much capital it's going to take for that down payment or for that purchase or for paying off that debt, etc., whatever it is that you're going to be using your policy or your system of policies for, is it possible, yes it is, to reverse engineer to make sure when we're structuring a policy that within those first 12 months, that you do structure the policy in a way to where you have access to sufficient capital to accomplish some of these shorter range goals you have. Again, I've already prefaced by saying that we should be thinking long range. We should be thinking about the whole course of our lifetime, owning and operating, profiting from, controlling this private asset for our private bank, and even thinking intergenerationally, the implications there. And yet, I want to be able to accomplish some shorter term goals when you have them by structuring the policy in a way that will allow you to accomplish those goals. So if you know that you're wanting to have a 10% down payment on some piece of business equipment or for some home, whatever the case happens to be, we can reverse engineer a policy to make sure that there's enough cash value for some of these shorter range goals that you have in a year or 5 years to be able to accomplish those things. So having a short range goal over the next year, over the next 5 years, and knowing a dollar amount that you're wanting to capitalize to can be a way of looking at how to structure a policy, what amount of premium is going to be necessary to facilitate this goal that you already have. Again, becoming your own banker, it's the most simple thing, is adding that one step to what you're already doing. You're already banking, you're doing it commercially, conventionally. I'm saying you can control it, you can profit from it, and you can, of course, depend, just like you do with a conventional bank, how much you're depositing into conventional banks. You can also be deciding for yourself how much you want to capitalize by paying premium into policies that you own and control. And We, in our conversations, of course, can structure the policies in a way that will allow you to accomplish these short-range goals where you know that in 3 years you want to have access to a certain amount of capital to be able to do X, Y, or Z. And we can structure that policy to be able to accomplish that, and then so much more, of course, in the future. So if I used an example here, such as purchasing a car, like what you would see in my presentation video, which if you haven't seen that yet, please make sure to go directly to my presentation video on the YouTube channel on my website where you can see this. But let's say you knew that you wanted to buy a car in 2 years, 4 years, whatever the case happens to be, and you figure that you're going to spend this amount. Well, we should be funding the policy in a way to where by that second year or that fourth year, whatever your goal is, that you have enough capital in that policy to be able to do that. You have enough cash value built up to be able to borrow against to go out and do the thing that you are going to do anyway, which is going to mean that you're going to be funding that policy. You're going to be capitalizing that policy at a greater level than that. So while we're not necessarily jumping in on the numbers right here, I'm just trying to give you some real life examples. Again, I show an example in that just for educational purposes, everybody is an individual, but I show a car purchase in my presentation video, and I hope that that's helpful. So we may resort to reverse engineering when you and I are having a consultation call about structuring a policy for your needs and purposes. Now, let me paint a bigger picture here with a few last points. Number one, again, in thinking long range, I want you to realize that Nash teaches us in his book that at some point, and will it happen in 7 years? Will it happen in 27 years? I don't know. You're going to be your own banker. But at some point, our premiums should be equal to our income. We don't start by getting all of our cash flow into policies that we own and control. We're just trying to find an appropriate amount of premium to get started, or an appropriate amount of premium to pay into a subsequent policy that's just adding to our system, much like commercial banks open up many branches. We are going to build a system of policies that we own and control over our lifetime, which means that eventually we will get to where our full cash flows or our full income can be premiums into policies. So again, that's something that you strategically and systematically can achieve over time, which for the next generation, those implications are incredible because they will not be starting from scratch, perhaps like you and I have and are. And yet, here's a little nuance. When you then remember that these companies that we own policies with can pay dividends, that means that you can even be paying more in premium than you experience in income, because the dividends that are produced by this system of policies is buying more death benefit, which is increasing the cash value of your policies even more. So just food for thought right there. Very interesting when I heard that for the first time. Nelson Nash explaining that you can actually even get to the point to where the premiums that you're paying exceed your income. Another big point to remember is that when you are paying premiums, you will experience a temporary loss of liquidity, meaning you will not have access to the full value of the premiums that you've paid in year one on a brand new policy. It has some illiquidity temporarily. Now, not a loss of value. So there's no loss of value. The premiums that you pay grow and compound over your lifetime. Whereas the value of the policy, the cash value in the beginning, has some loss of liquidity, no loss of value, some loss of liquidity in the temporary, to where perhaps you're accessing just a portion of the value that you've paid in premiums in year one or year two or year three, but that exponentially increases over time. And of course, you get to the point to where for every dollar of premium that you're paying, you're creating more in cash value than you've paid in premium. I hope you follow me on that. I understand that I'm just verbally explaining this, and there are places where you can see this in Nelson's Becoming Your Own Banker book. There are places where you can see this in my video content, but you get to where the cash value you created buy policies just from you paying premiums. Notice I've not said anything at this point about what if you are banking with that capital? What if you are banking with policy loans, leveraging that cash value? The game completely changes, which is the whole point here, that we're trying to decide what's an appropriate amount of premium for us to pay into policies that we're going to own and control for the purpose of becoming our own banker, for the purpose of implementing infinite banking. But again, I want you to understand that relationship in the beginning, because while you experience a temporary loss of liquidity only in the beginning, not a loss of value, but a temporary loss of liquidity, that flips and exponentially increases and improves. The older a policy is, the more efficient it gets. And dollars are creating dollars of premium paid. That's why premium is so important. Premium funds this whole relationship, this whole entity, and this whole process. Premium is the solution. James Nethery has said, premium is the solution. You have a problem, you have a need of capital. Of course you do. We all do. And that's probably going to increase over time, which means that we should be increasing the amount of premium that we pay over the course of time. Premium is the solution. There's going to be this exponentially increasing access to capital because of premium dollars that we've paid. They are creating multiples of themselves for us in the future. I hope that this has been helpful. These are common questions and methods that I encourage folks to consider when I'm having free consultation calls, strategy calls about their goals, their plans, their aspirations, their structure on policies, etc. So I hope that it's been helpful to you. And hopefully you are working with an agent or an advisor who has personally implemented infinite banking in their own lives. I myself have implemented this concept for going on a decade now, which is incredible and wild to think about and to say out loud. In my personal life, I've implemented infinite banking for the better part of a decade at this point on multiple policies from multiple companies. And I've been helping folks all across the country for several years now to implement infinite banking themselves. And conversations that we can have one-on-one where we can even begin to look at any inefficiencies that you have in your cash flows when it comes to static and lazy funds, or funds that are perhaps misdirected according to your goals and your plans and your actual intentions. I mean, it makes me think of a conversation that I had with an individual earlier this week where we're looking at his entire financial footprint, and we're talking about the gross annual income, sure, but then we're also talking about, well, he gets this bonus and his tax refund or payment typically looks like this or has over the past 3 years, and these are the withholdings, and these are the debts that he currently has, and these are the investments. And having a full, accurate, detailed picture of an individual's, from an agent's perspective, of an individual's financial footprint is so very important. But at the end of the day, this is about you deciding what is an appropriate amount of premium for you according to you. So if you have any remaining questions, feel free to put that in the comment section below. I answer these questions and comments myself. Otherwise, if you've not yet seen my full introductory presentation to the infinite banking concept, then I would encourage you to check that out. This has been a great pleasure for me. I look forward to our next conversation. Remember to live and leave a lasting legacy. Have a great day. Take care. What do you think is an appropriate amount of premium for you?